Hello, everybody. Welcome, everyone, to Finance Without Fear, a practical guide to financial terminology. I'm Jonathan. I'm the CEO and founder of the Consonance Group.
And I'm Mackenzie, and we're really glad you're here, especially if you do not consider yourself a finance person. This session is designed for executive directors, program leaders, and basically any non-finance staff.
Our focus today is helping you feel more confident with financial language and reports so you can use them for leadership decisions and not just for audits or grant reporting.
Yeah, and we're going to do three things in the next 30-ish minutes. We're going to demystify core nonprofit finance terms. We're going to show you how to read three key reports and also share a simple framework for indirect costs and releasing restricted assets.
And then we'll be sure to leave time at the end for questions. So as questions come up, you can put them in the chat or jot them down, and we can address that at the end.
So, Jonathan, when we work with nonprofits, what do you see leaders most nervous about when it comes to finance?
What I actually see is executive directors who are nervous about getting numbers questions from their board and not having an immediate answer. But your organization actually needs your questions because you connect the numbers to the mission. Your financials reflect the story of what's going on in your organization. There aren't really any surprises in the financial statements. It's just one particular point of view for telling the story.
Exactly. So financial literacy here doesn't mean doing the bookkeeping. It means understanding the language well enough to participate in discussion and decisions and push for sustainable choices.
When leaders understand the terms, they can spot risks, challenge assumptions, and advocate for what programs truly need instead of just nodding at reports.
That would be me. So let's start with some core terms that you see everywhere. And let's start with accrual. What does that actually mean?
Okay. Accrual accounting records income and expenses when they are earned or incurred, not when the cash moves. So if you are awarded a grant in December, but you don't get the cash until February, accrual accounting still shows the revenue in December because that's when you earned it. That's when the award was made. GAAP, generally accepted accounting principles, GAAP rules require nonprofits to recognize revenue at the time of the award, not the time of payment. So we're all working at some level with some version of accrual-based accounting.
Okay, so for leaders, accrual gives a more realistic picture of what your activity and commitment instead of just your bank balance.
Correct, exactly. Another term we want to get into is net assets. That's what's left when you subtract what you owe from what you own. So it's another way of looking at the organization's equity.
Okay, and what about classes?
So classes, this is a funky term because it's a QuickBooks term. This is for categories that you use to track different areas of activities, like programs, management in general, or fundraising. Like at a minimum, all nonprofits need those three because you have to report that way on your 990. Generally, we add additional classes and subclasses to match your particular programs, and that will enable more granular budgeting and expense tracking. So classes help you see how much it really costs to run each part of the organization.
Okay, that makes sense. And what about burn rate?
Burn rate is how quickly you're using up your available funds over time. It's often measured as average expenses per month. And if your burn rate is higher than the funding you have coming in, it's a red flag that you need to either adjust spending, timing, or revenue plans.
Yeah, that's a good one. Okay, so we want our audience to walk away with a practical term sheet. It's basically a glossary that you can adapt for your team. So let's go ahead and highlight three areas that we're going to include here.
Okay, first is the restricted versus unrestricted. This is the wonky thing that all nonprofits have to deal with. Restricted funds are dollars where the funder has specified how or when they must be used, like a grant for a particular program or project or for use in a particular time period. Unrestricted funds are flexible and can support whatever the organization needs most, including indirect and overhead costs.
Okay, so as a leader, knowing your true mix of restricted and unrestricted helps you see how much flexibility you actually have and where you may be over relying on a restricted project money to keep the lights on.
Exactly. Next batch of terms, income recognition versus assets versus cash. So income recognition is when you record revenue because it's been earned or promised, even if you haven't been paid yet. It's the accrual example we gave earlier. Assets are what you own or control. Cash, receivables, revenue that's awarded or pledged but not yet received, equipment, and so on. Cash is just one type of asset. That's the actual money in the bank accounts today.
Okay. So many leaders usually only look at cash and they either feel panicked or they're like overly relaxed. So understanding that difference between cash, total assets, and then the recognized income can really give you a fuller picture.
Yeah, exactly. The other term I want to hit real quick, in-kind income and expense recognition. When you receive donated goods or services, say donated supplies or volunteer time, professional services, you record those on the books both as revenue and a matching expense for the fair value.
Yeah, that way the contribution shows up in your financials, even if there's no real actual money changing hands. And that expense side reflects the true cost of running your programs.
Yeah. After this session, you'll get a sample glossary term sheet, and we encourage you to add a sort of plain language translation column for what these mean in your organization's everyday language.
Yeah, and for those of you who are here listening and learning, what questions so far do you have about terms? Is there any term that you have heard that you're still confused about? Maybe one we didn't talk about? You're welcome to take yourself off mute or throw it in the chat, but we want to be able to answer those questions about terms for you.
Okay. Then let's just go ahead and we'll move forward to reports. I'm sure other questions will come up as we move forward.
So now that we've established some language, let's talk about the 3 reports every leader should feel comfortable reading. What 3 make your shortlist, Jonathan?
Okay, the big 3 are the profit and loss, or statement of activities, the balance sheet, or it's also called the statement of financial position, and the third is the budget versus actual report.
Okay, so can we walk through each of these in plain language, please?
Right. So the P&L, the profit and loss, it's the story of your organization over a period of time. It shows what came in, revenue, that's the top half of the report, and what went out, the expenses, shown at the bottom. And what's left, the change in the net assets for the time period you're looking at, whether that's a month, a quarter, a year, is what's at the bottom.
Okay, so if I'm a program director, what should I be looking for?
Some key things to look at was whether your program's revenue is consistently covering its expenses, which costs are growing faster than expected, and also any one-time spikes or drops you need to explain to your board or funders.
Okay. And as an executive director, the P&L will help answer the question, are we structurally sustainable or are we covering gaps with like one-time fixes?
Right. And I know it may be too small to see the sample P&L on here. Shows 2 columns. There's the current period and then compared against the prior year or a prior month or some prior periods. You have a comparison of changes over time.
Perfect. Okay, so let's talk about the balance sheet.
About the balance sheet. So if the profit and loss is the movie, the balance sheet is a snapshot at a specific point in time. It shows what you have. It's the asset section, the first section of the report. What you owe, the liabilities that are below that, and what's left, your net assets.
Okay, so as a leader, what questions should I be asking when I look at this?
Well, you might ask, of course, how much cash do we have on hand? Shows you very clearly. How much do we owe? So it'll show your payables, loan balances, credit cards, and that net asset section is going to show if you have a cushion or if you're really operating on a very, very thin margin.
Okay, so this will be like the runway. Like how long can we keep operating as we are before we have a problem?
Exactly.
Okay. Now, finally, this is really important one. Let's look at the budget versus actual report. And why is this such a powerful tool for the leadership people who aren't in the finance seat?
Correct. Well, this is the reality check against the plan. It compares what you planned to receive and spend versus what's actually happening. So the important part here is the variance. It's the difference between the budget and the actual.
All right. So what kinds of questions should leaders ask when they see this variance?
The three big ones are, is this just timing? For example, is there a variance between the budget and the actual because a grant came in later than expected, or a vendor invoice arrived later because the timing of something was off? Second, is this a trend? Are expenses consistently running high in a specific area? And the third question is this a one-time event? If there's a large variance, is it just one unusual thing that happened that is not going to repeat? You're going to want to be able to explain that.
Okay. And then once you know what it is, then you can decide whether to adjust spending, revise your forecast, or bring something to the board's attention that needs to be discussed and,
right,
fixed possibly. Are there any questions from our attendees about these three reports? These are obviously very big and important and sometimes very overwhelming. So while we have Jonathan here, let's pick his brain. What questions do you guys have about these three reports?
All right, we got a quiet group.
Don't be shy.
I don't have a question about these three, but I'm curious actually because I use the P&L and a statement of cash flow. Like, should I be maybe using a different one instead if I'm trying to give an organization a snapshot, which is like the balance sheet, just like where they currently are with their cash?
I rely on the balance sheet more than the statement of cash flow.
Okay.
Because that will show you at the top, generally the top of that asset section will be the bank balances. Will show you the cash on hand.
Okay.
And it's also going to show you outstanding liabilities, which are not reflected in the cash flow document. So you can see if there are payables, loans need to be paid back, other like outstanding liabilities that are going to come due in the future.
All right. Okay, that's very helpful.
Yeah.
Thank you.
That was great. Anybody else have any questions or, comments or, another report that they want to ask about?
Jonathan, this is Amy. You might get to this in another place. Maybe I should put my camera on. Anyway, the budget for maybe especially for smaller organizations or maybe new executive directors, when they see a budget versus actual, they or maybe their board members who might be let me not say less sophisticated. Some board members might want to change the budget in the middle of the year to match the actual. Maybe this group knows not to do that, but do you want to say a couple of things about how one might talk to a board member who's suggesting such a terrible idea?
I like that leading question, Amy. Thank you. Yeah, generally the operating budget that the board has approved is what you're going to report on throughout the year. And if you're going to make changes to that, that's going to require a second round of board input and approval. So it's oftentimes a larger project than what's necessary. Any budget versus actual report is, and any budget, let's back up, any budget is your best guess about what the future is how the future is going to occur, and nobody knows the future. So there's always going to be variances, and it will always be necessary to explain those variances. Generally, certainly, the more complex the organization is, the more difficult it is to modify the budget mid-year. So if there's a major change and it's worth the effort to do a full budget modification, then that's something to be undertaken. But generally, if there are variances because something's unfolding a little differently than we expected, it's best to just explain that in like a narrative or in notes to the budget versus actual report. And so that each quarter or each month, as the board sees it, they know that, okay, the budget was, we were going to do 5 events this year, and it turns out we're only going to do 2. Like, you just include a note for that, and you don't need to go through a whole budget revision process.
So going along with that, what would you consider, and I know that this is going to be different for everybody, but what would you consider like would be the major change where like it should change?
I don't have a hard and fast rule on that.
Okay.
It's just, it's a question of the cost benefit of like the complexity of the entire organization's budget. If you're going to open all of that up for another round of consideration and reworking, there's a lot of labor involved in that.
Yeah. I love what Amy's saying. Amy's saying it's not a grade. It's if you exactly meet your budget, you get an A. Like, yeah, that's
right. And that variance is normal. Again, that's exactly right. Like things don't happen exactly the way we expect, and that's absolutely normal.
okay. Wonderful. These are great questions. Anybody else have something they want to ask or add? All right.
All right. Well then.
All right. So a common pain point we hear in this space is, I have no idea if we're handling indirect costs the right way. So can we simplify that some?
Well, we can try. So first we'll define direct versus indirect. Direct costs are expenses you can clearly tie to a specific program or a specific grant. Program staff, supplies for a specific program, travel for a specific program, all direct costs. Indirect costs are shared expenses that support multiple activities, like organization-wide expenses, rent, administrative salaries, insurance, technology.
Yeah, the key for leaders is really not to memorize every rule, but be sure that you define within the organization what's direct and what's indirect in writing so that everybody in the organization is working from the same playbook. Everybody knows.
Exactly. Really, being consistent is often, in my experience, when you're doing accounting, being consistent is more important actually than being right all the time. As long as you're consistent, anything can be fixed.
Yeah. Agreed.
Okay. Sorry.
No, you're good. No, I appreciate that extra little bit. It's a really important. Communication is key. That's what I always say. So can you walk us through a simple framework that leaders can use with their finance teams?
Absolutely. So here's our straightforward 3-step framework. First, define in writing what is direct versus indirect. Decide which costs you treat as direct, which as indirect. Document that in a short policy. Second, this is the hard part. Choose a reasonable allocation base. So we pick a logical way to spread indirect costs across programs. And there's a few methodologies that are standard. Common bases include total salaries, or sometimes somebody will say total effort. That's a way of measuring how much work a particular program is. Total direct costs, or square footage. If you're operating a facility and program A takes up 80% of the square footage, and program B is 20%, whatever, you can use those as the base. The exact method matters less than being reasonable and consistent. Step 3 is to apply that methodology consistently and review it periodically. You have to use the same method across all the programs and funding sources so that, again, that consistency is right, and then it's equitable to all of your programs and funding sources. Then revisit that every year or two to make sure that it still matches how you operate.
Yeah, and having that written and consistency doesn't really just make auditors happy. It does make them happy, but it also makes it easier to explain like true program costs to your board and then the funders as well.
Exactly. That's exactly right. Are there...
Oh, yeah. Any questions? Yeah, I just want to make sure. Is there any questions about this kind of simple framework that Jonathan explained?
Okay.
All right.
Good. Well, then, if we're going to keep it simple, that's as much as we do.
Yes.
Indirect allocations.
Yeah. So now let's connect this to releasing restricted assets. And this is an area that really confuses non-finance leaders right here.
And I have a disclaimer before we get too far into this.
Yes.
Our CFO reviewed this and wanted to make sure that I explained very clearly that what I'm going to show here about restricted assets, this is actually is one possible way of handling restricted assets. It's a common approach for small organizations. The actual ways there's a lot of nuance in this, because there are a lot of different ways that funding can be restricted and different ways that those restrictions can be released. So this is a simple example of a common approach. But this is a simple way to think about it. When you receive a restricted grant, you book it with what's called with donor restrictions. As you incur eligible direct or allocated indirect costs for that purpose, you gradually release that amount into the category called without donor restrictions. So the release should match when the allowable costs are incurred, as not just when cash arrives or when you remember to move it. It's something that should be done consistently on an ongoing basis. And this is, again, assuming that the restriction is purpose-based. So if you have funding to support a particular project, as those costs are incurred, then you can release those funds from restriction.
Okay, so let's talk about this a little bit in more of a practical situation. If I have a restricted grant for a youth program, and in a given month we spend on staff time, supplies, and a fair share of rent, and then the admin for that program, we can charge those direct and indirect costs to the program and then release the restricted net assets in an amount that matches those total costs.
Exactly. And that way your financials show that you use the restricted funds for the intended purpose, and it would show your unrestricted category accurately. So it's not artificially low or high because the releases haven't been booked, or because you've released too much too fast. It really helps you, again, tell the story of your actual operations.
Yeah, and to help, we are going to be sending you a one-page like framework kind of worksheet that you can use to either document or, help you brainstorm your own, because, of your own variances that you have going on, that will help with the definition of direct versus indirect, your chosen allocation base, how and when you release the restricted net assets. Again, we understand this is just a very simplified way to do it, not the only way to do it, or, we understand that. So this is just to help you get your juices flowing and brainstorming and understanding it yourself.
Exactly. So that document eventually will become something you can sit down with your finance staff, your executive director, your board. You say, here's how we do it, and here's why. And then everyone can be on the same page. All right.
So yeah, that's our core content. But we want to hear from you. We've set aside this time for you.
So please drop questions in the chat, or just take yourself off mute if you have any questions, things that feel fuzzy.
I just want to say thank you for, it was really interactive. Mackenzie, your energy is really great. It's, earlier on the mountain time, and I love it when people come into a webinar enthusiastically, especially when you're talking about finance. So I just want to just reiterate how much gratitude we have for you taking the time to give us these definitions. And I'm really excited about you sending the slides and the recording.
Absolutely.
Thank you so much.
So I know one question that we actually get a lot is, where do I even start if our current reports feel super overwhelming?
Sorry. The where to start question is a common one. I say pick one program or one report. Ask your finance person to walk you through that section of the P&L or 1 month of the budget versus actual. Just start small. And untangle for yourself like one section or one of the reports at a time. And that's a great way in. I think a lot of the terms we introduced today, like the way they relate to one another, will click into place when you begin looking at the actuals for your organization, and you see that this is actually the things we know in real life to be occurring. We're just seeing the financial impact.
Okay. Yeah. I think zeroing in on one thing one program, one report helps you start to understand if you're a non-finance person. Catherine has a question. Go for it, Catherine.
Thank you. Okay, I would love to hear more about the in-kind process. I know you mentioned that earlier, but I work with a lot of fiscally sponsored projects, and this email just came in today, actually, so it's perfect. They're starting to plan for a big event, and they're curious how they might, and actually, should they track in-kind donations? And if so, what do they have to report to us as their fiscal sponsor? And I just don't really understand that process. To me, it seems just kind of like made up. It's all like theoretical, so I don't understand.
So in-kind often feels made up because you're putting stuff on your financials where money didn't actually move. But the task really is to recognize both the benefit received from the donated goods or services and the cost that would have been incurred if those things weren't donated. So you're trying to show the value both on the income and expense side of any contributed goods and services. Does that, I don't know if that's enough to answer the question.
Yes, that's very helpful. Thank you. And so you just code it as like a normal transaction just based on, no.
No, you want to create a separate line.
Okay, we do have
revenue
that.
for
We do
in-kind
have that.
revenue and a line for in-kind expense, so that you
Okay.
can view financials with or without those things. But when you look at the aggregate numbers, you're seeing the true picture.
Got it. Okay, that's super helpful. Thank you, Jonathan.
Sure. And also one other, just if I didn't say this explicitly, the income and expense, the in-kind revenue and expense numbers are the same. So that nets to zero so that your financials there's not an impact on the bottom line because it's donated. There's no money moving around. So we just want to make sure that those net out to zero.
Awesome. Another one that I hear a lot and I've experienced a lot is, how do I tell when a budget variance is a timing issue or if it's a real problem? Like, when should that like yellow flag, like, oh, this might be an issue, like be turned into like a red flag with like blaring sirens?
It's going to depend a little bit on how the budget is formulated to begin with. If a budget is broken out by month or by quarter or something and your timing is incorporated, it's easier to see, oh, this is in the budget for next quarter, or this thing that happened we thought was going to happen last quarter. If the budget is just a summary budget for the year, the timing things might be a little bit harder, although we often get into this with organizations that have activity, like stuff happens near a fiscal year boundary. So it's maybe something we thought was going to happen last year, and it came in at the beginning of this year, or similarly at the end of the year. We have one client, for example, puts on a huge conference in the June, which is the final month of their fiscal year. It has a huge impact on the books, but all of that impact happens at the very end. So they're often timing things that, because there's expenses that aren't actually incurred until the next fiscal year, and we have to make accrual entries to move them against it gets complicated. But this simple fact is you have to just connect with real life. You will know, is this something that we just expected to occur at a different time, or is this something we didn't really anticipate?
Okay. Yeah. Something to be paying attention to at least, or have your eye on it.
Mm-hmm. But it's certainly a simple practice to often reports, you can request them this way to show the variances by dollar amount and the variances as a percentage. So you could very simply just look at, variances over 20% or something. We'll immediately pull out where there are potential problems. And then it's a question of like, what really happened that made this variance that big?
Okay. That makes sense. Thank you. Anyone else have any questions for Jonathan? Okay. Before we log off, I just want to clarify what you're going to be getting today. You'll be getting that glossary, how to read your reports cheat sheet, which may or may not already be printed and posted on my wall right here, so that I am constantly reminding myself how to read these reports, and also that kind of worksheet flow that you can use or use for your own nuances to help you brainstorming them.
Okay. Well, thank you so much for joining us today for our first ever webinar. We appreciate it. We appreciate your feedback and comments. And certainly let us know when you receive the materials if you have other questions or feedback as well.
Yeah. And if you're interested in bringing this training or a tailored lunch and learn series to your organization, please reach out to us. I think in another slide or two, Jonathan's got his email up there for us.
I'm sorry. There we go. Contact information.
You can find us on LinkedIn, our website, obviously. So we are here to help you. We really appreciate you spending your time with us today.